Hello value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk to you about Bill.com. So we're going to go about what Bill.com does, we're going to talk about its growth rates, we're going to talk about the fact that it's not really that profitable yet, and we're going to talk about its valuation. So I'm just going to jump right in, okay? So Bill.com is growing at a very rapid rate, and you can see here that its guidance for the year ahead is for triple digits. This is something very, very compelling. First of all, every investor wants to see visibility. Second of all, you're showing triple digits, so that's just great. And thirdly, acceleration. Anytime that a company is accelerating its growth rates, investors have difficulty quantifying that, because when the company is stable, it's easy to say more or less what a company is worth. Or if the company is contracting, the multiple compresses. On the other side of the equation, if the company is expecting growth rates to continue to grow stronger and stronger over time, investors have difficulty quantifying that, and that leads to a very wide range of outcomes. In certain instances, it's justified to pay a very large premium for a company that can continue growing at very rapid rates for a very long time. On the other side, sometimes that doesn't happen, so it's difficult to know on the price of it how it is. So what does actually Bill.com do? So Bill.com is essentially an accounting platform aimed at small and medium-sized businesses. Okay, so getting the receipt, making sure someone's paid, contacting the supplier, all that is quite convoluted and it's quite difficult, and sometimes you have to go through various loopholes. So what Bill.com does is, on one platform, it just streamlines everything from the accounts payable to the accounts receivable, so it allows the connection between the customer and the client and between the customer and the supplier. So it just streamlines everything, gives visibility into the financial workflows and the cash in, cash out. So it's quite a sticky platform that we're going to come to next. Okay, so one of the things I want to highlight is the number of customers adopting Bill.com. It continues to increase, so it's up 24% year over year. It's not particularly strong, but it is. You do see customers coming up, and more customers joining the platform. Now, what is particularly exciting here, you can see total payment volume. Total payment volume was up 64% year over year. So you have more customers coming in, and they're using the platform more and more. So that's really the virality here, and that's why you're seeing such a fast growth rate on top line. They do have some acquisitions as well, but I don't think investors are going to get too caught up in what's acquisition, what's organic right now. I think investors are just squaring their minds on this fast growth rate. Now, one last thing that I want to highlight. It has a dollar-based net retention rate of 124% for the year. Okay, so it's up from 121% the previous year. What that means in practice is that a customer comes on board, and after a year they're upsold 24% more revenues. So that's quite attractive, because it shows that the customer stays on the platform and uses more and more of its services. It has a usage-based model for a portion of its revenues. So as the customer uses more and more of Bill.com, they take a small fee, and that's really why you're seeing such a high and strong growth rate going ahead. Now, one of the things that I wanted to highlight is that its non-GAAP gross margins are inching higher towards 80%. So it's a high gross margin business, and that's something that investors just, strong growth rates, high gross margin, something that's very, very attractive. One of the other things I want to highlight is that from a free cash flow perspective, they're not actually free cash flow generative. So you can see here that for fiscal 21, they were negative 17 million, which is flat with the previous year. So even though they're expanding fast on the top line, they're not seeing that operating leverage. They're not seeing that translate into strong free cash flow on the bottom line. So that's one of the negatives here. So investors are paying approximately 59 times forward sales, which is a punchy multiple. As I said many times already, it's kind of justified, because they're growing at such a fast rate. It's kind of difficult. So if a company can continue to plow back its free cash flow and grow its top line as triple digits, you can do that all day long. As long as you keep showing to investors you can grow the top line at triple digits, investors are going to give you plenty of space to do that. On the other side of the equation, they carry about 900 million of debt and convertibles, so it's not that much flexibility. They only have 1.1 billion of cash. So this is outdated slightly because the quarter finished a couple of months ago. But for all intents and purposes, it's a bit of a restrictive balance sheet, so they don't have a lot more wiggle room here. They do have some space, but they don't have a lot of space. So some pluses and minuses that I wanted to highlight for you. In any case, if you want to find out, you can see other companies like Xerox Limited, not Xerox, different company. Xero Limited is a cloud-based company and is priced at 14 times forward sales, and Workday is priced at 11 times forward sales. So none of these companies is priced anywhere near what Build.com is priced at. On the other side of the equation, for example, Workday is only expected to grow at approximately 20%. So it's not growing that fast either. So with that in mind, that's why investors are paying such a high multiple. In any case, if you want to find out what kind of stocks I'm looking to invest right now, don't forget to check out my marketplace called Deep Value Returns, and I help you become a better investor. I'm really a place that you can come in and get high quality, actionable investment insights, helping you think through a framework of investing. Okay, see you guys next time. Bye bye.